Good evening, everyone. Pleasure welcoming you all for NASCOM India Fintech Awards, Knowledge Series Future of Fintech. The objective of the series is to understand from the experts on various topics of the fintech space about upcoming innovation and trends in the sector. Parallelly, we have been inviting applications from startups incorporated in 2018 or later for the Fintech Awards under various categories like payments, insurance, lending, financial inclusion, retail banking, and regulatory compliances. The link to apply for the same will be in the chat section in due course of the event. Today's session is on one of the most important fintech spaces, lending. India has a unique fintech lending ecosystem due to the nature of its market and regulatory approach. With technological advances and a conducive policy environment, alternative lending as a service has caught the eye of consumers and investors alike. Fintech lenders have capitalized upon the needs and pain points of the consumers across the lending value chain for a seamless, automated, and personalized experience. We have aimed to comprehend on some of the innovative ideas that came through COVID times and the road ahead on the space. And today we have two eminent players, Sashank Rishyasringa, co-founder CapitalFloat, and Rohit Singh, CEO and co-founder NIRA, to help us with more insights in the lending tech space. Handing over to you, Rohit and Shashank.
Thank you. So, want to say thank you for giving me the privilege to be part of this, and thanks for everyone who logged on. I guess Sashank and I, we can introduce ourselves and we can just take it from there. I think our plan is just to have a pretty free-flowing conversation. Let's see where things go. And this year has obviously been super interesting because of COVID, so there'll be plenty to talk about there. And then we can also talk about how we think lending might play out going forward. So just to introduce myself then, so I'm Rohit, one of the two co-founders at NIRA. And NIRA is a still pretty early stage company. We've been live for about 2.5 years. And we're a consumer lender. In particular, we're focusing on like the lower middle class. So most of our customers are people who are earning less than 30,000. So 15 to 30,000, our sweet spot. Sashank, do you want to introduce yourself from CapitalFlick?
Sure. Thanks, Rohit. So Rohit and I share a similar space. A CapitalFloat is about a 6-year-old company. Really started out with an attempt to bring technology into the credit problem in India and figure out how to democratize access to credit and financial products for middle-income populations with a focus on self-employed and small businesses as well as consumers. We think of ourselves as an integrated digital finance platform offering 3 main products to our customer base. The first is cash loans and cash lines, which could either be for personal or for business use. The second is buy now, pay later, which is essentially a credit facility, which is a blend of payments and credit to help customers, particularly those who may not have a credit card, be able to purchase online and in both solve the problem of affordability as well as convenience. And the third is personal finance management, where we provide a suite of financial management tools such as budgeting, saving, expense tracking, etc., to help individuals better manage their finances. Our sweet spot is targeting individuals who typically earn anywhere from 2 to 5 lakhs per annum. And the common features of this segment are significant proportion new to credit, significant proportion without a credit card, and a very large, over 50% actually being self-employed, so working for themselves or running a small business of some kind or the other.
All right, great. So, Sashank, I just thought, just to start with, let's just talk about you for a bit. You've got a very interesting background. So, before you're at CapitalFloat, you had on paper at least what looked like, the stellar or the dream position. You were, Ivy League graduate. You're sitting in McKinsey, top consulting firm in New York. How did CapitalFloat come into the picture? Was it you wanted to come to India and then CapitalFloat came about, or was it you had the idea first? How did it all start for you?
Yeah, it's an interesting question, Rohit. So I think actually, funnily enough, we started as a team before we were a company. So my fellow co-founder Gaurav and I were actually both studying our MBAs at Stanford. This was just after a long stint at McKinsey for me. And I think we had both discovered a shared ambition to move back to India and build something that had impact and scale and touch the lives of millions of customers. And that had been a very kind of conscious desire of mine through the years in consulting as well. And what initially kind of got us going on our entrepreneurial journey was the fact that we had very complementary skill sets and this common aspiration. I think interestingly enough, as we looked at multiple business ideas across the country, we found that there was pretty much hotbeds of entrepreneurship wherever we looked. But the one common kind of gap across the board was really access to financing, right? And I think the other insight, at least that motivated us, was even as we looked at equity financing, which is very much kind of, I would say maybe the top 1% of a certain kind of tech, quote unquote, startup. The vast majority of individuals and entrepreneurs in India really needed debt to get started and to scale and build their businesses. So that was our starting point. And I think as we dug deeper, actually, I think at that point being in the US was an advantage because we had a chance to study a lot of the fintech models coming up at the time, right, around P2P lending, around digital payments, as well as what was really happening in China. And I think it became very clear to us that three things became very clear to us, actually. The first was that the size of the opportunity in India was just massive, right? And now this is very well documented. But back then, I think very few people had realized that over 60 to 70% of SMEs and over 80% of consumers in the major cities actually were digitally savvy or had an online footprint of some sort. Back then, kind of technology businesses were very much limited to the large cities and the top echelon of customers. I think the second was really around the rails, right? So I think this was pre kind of India Stack, pre UPI, pre
Yeah.
Geo. But I think the punt that we felt comfortable taking was that we could see a 5 to 10 year horizon when things would really kind of start to fall into place in India in terms of digital infrastructure. And then the third was just looking at models both in Europe as well and the US and China that were just growing really quickly at that time. This was around 2012. So I think this sort of trifecta gave us a lot of motivation to take this leap of faith. Obviously, personally, I think it was quite a change.
Yeah.
But I was very excited at an opportunity to kind of build something of impact. I had spent a lot of time globally, kind of advising large financial services firms and also helping them think through kind of new product innovation. And I think consistently, what I saw was so there was always a digital initiative team in every bank, but it was essentially looking at technology as a way to enhance the existing suite of products and infrastructure that most financial institutions had. And it seemed that there was an opportunity to actually take a digital first approach and reimagine what the financial institution in the next 10, 20, 30 years could look like in India if it was actually built from the grounds up, from first principles thinking, and with the small consumer and technology at its core. So that was personally very exciting, having seen some of the challenges around digital transformation in large financial institutions globally. And so I think it was a combination of these things that kind of led to the move back home.
That's, I mean, super interesting. And I'll tell you what I find particularly striking. There's actually a good degree of congruence, even in my own journey, on a number of points that you've made. So I'm slightly different in the sense that I grew up outside India. So I was born in the UK, grew up in the UK, did my university there. And I had a long career in London, actually, before I came to India. But I used to visit India frequently to, see my family, of course, extended family. And every time I came here, I could see the progress or things moving on from the year before, right? And in my mind, I'd start extrapolating. Imagine how this place is going to be in 10, 20, 30 years' time. It's going to transform beyond all recognition. And like my mind would be exploding with ideas for businesses. Every time I came to India, I had an idea for a business. But like you, I think the one that when it really struck, and it was enough for me or to compel me to leave my job, was the emergence of the fintech industry in, as you said, the West and in China. So I used to work at Goldman Sachs, and 2012, 2013, there were a bunch of relatively early stage credit companies, both consumer and SME, in London and Europe. And they would come to us looking for finance. They want to ramp up their business and they want finance. And obviously, most lenders or most businesses aren't going to give it to these new upstarts. But at Goldman, we could take a look. So that's when I got a good understanding or look under the hood of these businesses, the models, what they're solving. And it's also when I put the two and two together of this idea of let's use data and technology to solve financial problems is possible with a massive opportunity in India. Like the magnitude of the problem that you can address in India is way bigger than anything I was seeing in Europe or US. And lastly, my skill set or experience set was credit. I've been managing credit risk or trading credit for 12 years. So this is the one where I'm like, okay, of all the opportunities in India, this is the one where I back myself to go and execute. So it took me a bit of time to pluck up the courage, but it got to the point where every time I read something about India, every time I read something about entrepreneurship in India, I even saw, the headlines about Capital Float when I was still sitting in my seat at Goldman. I thought, I have to do this. I won't be able to live with myself if I don't give it a shot. So, I've been in India nearly 5 years now, no regrets, still very excited. So let's talk about what's been happening, right? So Capital Float has grown into one of the premier fintechs in India. So before we go into COVID, let's just talk about just before COVID, you're coming into 2020. How were things at Capital Float? What was your focus? And yeah, like what was your priority coming into this year?
Sure, Rohit. I think that's an interesting question because it's very hard to imagine 2020 without COVID. And actually, I think you wrote a very interesting article, I think, recently on how COVID is going to change the lending landscape. So I'll actually use that as a jumping off point because I think some of the themes really resonated. I think one major theme, I mean, it's almost starting backwards, is around capital supply, right? And I think the last 2 years in India was in some ways a major kind of reality check and a growing up phase for the entire financial ecosystem, but particularly fintech, because we were all relatively young before hitting our first major crisis, which was ILFS, and think of COVID as sort of a part two to that, right? And so I think a lot of the thinking, at least for us around 2020, going into it, was really around resilience, right? And I think resilience in two major areas, three actually. The first was around kind of risk models and underwriting and collections. The second was around capital supply, and the third was around organization and team. And I think these were the kind of the three lenses that we were looking at this year and saying, look, we've learned a lot on all three over the last year and a half through the ILFS crisis. How do we build the right muscles to really create a more resilient organization that's able to kind of power through the next phase of growth? Now, it so happened that COVID kind of came pretty much just after a couple of months of recovery post the credit crunch. But I think on the flip side, it meant that us and I think several other players in the ecosystem were probably a little better prepared to take on some of the shocks of COVID because there had been a preview or a pre-learning in the few months that passed. So just to take each of the three, right? I think on risk models, I think a major area of investment for us actually the last 2 years has really been around collections, and not necessarily the traditional form of collections where you have a bunch of people kind of running around in the field, but really how do you build collections as a strategic in-house capability across technology, people, processes, and also creating kind of also messaging and product design, right? So that was, I think, a major theme in risk. And the second was around calibration, right? I think there's always been a question like, how good are your models in fintech, right? And I think the great thing actually about the last few years is we've actually been able to have them tested through a macro event and be able to make the right tweaks and also see where the models are working well. So they are, I think, no longer kind of fair weather or kind of upcycle models, but actually cycle tested models. And I think that has been a major area of focus. On the capital supply side, I would say a lot of 2020 and the kind of the lead up to COVID was around deepening and diversification. So on the one hand, kind of working with several different constituents, banks, NBFCs, family offices, etc. But secondly, also creating more kind of flexible structures, right? So for example, for us, our marketplace model where we essentially co-originate with large financial institutions became kind of a key focus area of this year. It's something we've been building for the last 2 or 3 years. Uh, but particularly in the last 12 months, I think we've seen a lot of new exciting partnerships. And I think particularly since COVID, we've actually seen a couple of bank partnerships really scale as we've kind of been trying to capture the buy now, pay later opportunity that COVID's unlocked thanks to rising e-commerce trends. And I think the third is really around org and kind of building a culture of resilience, kind of building a certain amount of through cycle thinking, creating the right tension between risk and growth within your teams, but also figuring out how to ensure that the decisions land on the right side of that trade-off. Sometimes you need to go slow, but at the same time go fast in certain areas. So I think that's been the other major theme. But as I said, I think it was really I think interesting to read your thoughts and curious how you guys, as someone who kind of is probably earlier in the growth trajectory, how what it was like to experience 2020 or even 2019 from a founder and all perspective.
Yeah. So we came in. So I mean, we're definitely much earlier than you, as we both know. Um, I would say I mean, after some, iterations and pivoting and testing stuff out, we finally found product market fit, probably September 19. Something just seemed to click. We finally thought, okay, something's working now, right? And we started growing very quickly. And it was literally like the market was pulling us. It wasn't, before that, we were constantly striving for growth, but then suddenly it flipped like a 180 and the market was pulling us. So we started growing really quickly. And we came into 2020 just thinking, we just have to keep growing now, keep scaling, making sure then that we're scaling the organizational capacity along these dimensions that you talked about, to make sure that we're building a resilient business as we scale up, and we don't get caught offside if things turn, because obviously always a risk in finance. Now, COVID, of course, changed everything, right? The economy all of a sudden is going to come to a grinding halt. So our priority, of course, shifted immediately from growth to collections or this performance. I guess I had a bit of an advantage in this respect because I've been through financial crises before, right? So I used to trade mortgage-backed securities. So I had a front row seat on the 2008 crisis. I had a front row seat of the sovereign debt crisis in 2012 to 2014, and even 15 it was still going on. So I had a good awareness of things can change really fast, get really bad, and NPAs or performance could really deteriorate really quickly. So very early on, I was on the phone a lot to all my people I know in Europe, China, New York, like what's going on in your place? What are you seeing on the performance? Trying to get ahead of the crisis that I thought was inevitably going to come to India as well, right? I mean, just a couple of weeks before we had lockdown, we had Trump in India with Modi, and they had a stadium of 150,000 people. Everything was still going all guns blazing. But it was clear as day to me that this is going to come to India as well. So it's preparing for that. So making changes to things like underwriting policy, preserving runway, even warning the team, have you got provisions at home? Have your family got provisions at home? Have you got, like, early warning indicators for me was hand sanitizers were becoming harder and harder to get, right? That's an early warning. I was like, stuff is going down here, it's coming. We did practicing working from home, which gradually shifting from 100% work in the office to 80%, 60%, 40%, then 0%. So there was a lot of anticipation, but obviously still it's not perfect, right? We don't have perfect foresight. And when I look at our data, that March cohort performed worse than all the other ones, right? We still turned off the taps or turned down the taps. It never went to zero. Still a bit too slow, right? So we are an earlier stage company, so we didn't have. I think you had more to manage in terms of the scale of all the things that were going on. But on our scale, I think we managed to get it down and get it tight pretty well. And then I think the other thing that we did was where most people stopped lending because the economy was obviously so bad, we did continue doing some lending. And the thinking behind that was, I need information as a risk taker, as a risk manager. So it's like taking small size bets. I'm taking small experiments. I'm putting risk out to the market and I'm seeing what's happening. I'm getting real-time information of who's applying, what's their income doing, what are they applying for. And then quite quickly, because within a month you start getting your first payments, you start to see what works and what's not working. So we could actually build a playbook of where can I deploy risk even in this tough environment? Because COVID or the lockdown affects a whole nation, but it affects different groups to different extents, right? There will be airlines, of course, they're in big trouble. Hotels are in big trouble, but someone who's working in an IT firm, for the most part, can still work at home, right? So there were things like changing our underwriting policy to accommodate that. We changed things like accepting whatever credit model we had built before was based on an economy which is growing, right? An economy where things are okay. That's not valid today, where you have a minus 24% GDP in one quarter, right? So we just had a simple yes, no, either you qualify or you don't qualify. So there are a bunch of adaptations like that. And on the whole, I think it's worked well, right? So I guess the last point we had to make was what's our attitude towards moratorium, right? And even there, in the end, we took quite a firm stance because my co-founder and I, we talked about it. And as I said, I've seen a lot of financial crises before and understanding what's the effect of forbearance. It's very hard, I think, particularly in our target market, where if someone hasn't paid a payment for 3 or 6 months, to then expect them to start paying again after that. And while I can understand the motivations for everyone to like or get behind the moratorium, banks don't want to report the NPAs. RBI doesn't want banks to report NPAs because then then there'll be capital shortfalls. As a lender, there's a cost of forbearance, right? You have to then expect everyone to start paying again. So we avoided that to the extent we could, right? We only had 2% of our loans going to moratorium. And I think that served us well in the end. So we've, coming out this with a pretty clean slate now, rather than having a big day of reckoning when moratorium ends. Yeah, so I guess the follow-on question for you would be, so you had this mini crisis to manage from the ILFS, right, from 2018-19. It allowed you to some extent to get your house in order. It's like a good trigger for you to say, okay, let's sort things out and, as you said, build resilience. So when COVID did strike, which was a much bigger crisis, to what extent do you think you were well set as a result of those changes that you made? And then what did you then subsequently still have to do in response to this crisis?
Yeah, I think when COVID first happened, right, which really started with the triggering of lockdown, no one really knew what the future might hold, right? So
Right.
I think at least in April, everyone went into a bit of a shell, and I think kind of just was in wait and watch mode. Um, Around, I would say, May, June, we started to see some really interesting trends, right? They kind of changed our attitude towards the COVID year. I think the first is, while obviously there were sections of the population and particularly, for example, in the small business space that obviously had been quite affected and needed time
Yeah.
to recover, we did see that a lot of kind of digital repayments were starting to come back, right? I think we almost in September we saw collections efficiencies almost back at like a 93 to 94% level. And on a fairly sizable book, I think that was actually a remarkable number, well ahead, probably 20 to 30% ahead of the forecast we had made for ourselves in April. So I think that was a kind of in some ways quite an interesting phenomenon. It gave us a lot more confidence around the underlying recovery in the economy around COVID, obviously patchy and still continuing. It's certainly better than we had thought it might be.
Yeah.
I think the second was a really interesting trend, um, which was really kind of the rapid growth of what we call buy now pay later, right? So I think we saw, at least for example, on our own app, we saw that within a few months after COVID, e-commerce spending had returned to pre-COVID levels and actually gone past those, right? I think in September they were almost at about 150 to 200% of pre-COVID levels. Offline retail spending had fallen to about 60% of pre-COVID levels and still remains there. And I
Yeah.
think what this meant for us as a business was that um, kind of our product to essentially enable kind of middle income uh, customers to be able to actually purchase online on credit uh, grew really quickly, right? And I don't think we were alone in this. This is a trend that I think has been observed globally, in the US and in Australia and in other countries as well, which is a kind of COVID triggered a very sharp substitution towards e-commerce and online transactions. And at the same time, digital first kind of payment and credit products that were embedded in these ecosystems grew at a very similar pace and with very good quality, right? So I think just even in the last few months, we've seen us add over kind of 800,000 new customers, which is more than we probably added in the couple of years before COVID, right? So, and the even more interesting piece is the risk levels in these customers are actually half of what they were prior to COVID, right? So you're seeing kind of this dream phase of growth with lower risk, which I think is, and there's no magic behind it. I think it's very simply a function of, as you said, product market fit being kind of accelerated because of COVID, because a lot of
Yeah.
the traditional kind of barriers around using digital first means, signing up for a product online, completing a video KYC, setting up a digital repayment instrument. I think these sort of micro barriers, if you will, were effectively just eliminated during the first few months of COVID, and I suspect for good now. And I think the second is, I think the kind of digital transacting nature of the population has just shifted to a very different trajectory. I think um, in some ways, I think in the last 6 months of COVID, we've achieved what we expected the country to get to in the next 3 or 4 years.
Yeah. So it
So
sounds
I
like
think that
it's similar to, I guess, the effect that demonetization had to payments. This is also this exacerbate, catalyzed just the continued presence of use of digital transactions for now credit as well as just payments.
I agree, and I think while demonetization was a somewhat transient phenomenon, and we did see a lot of cash come back in the system, I personally think, sorry, that the digital shifts through COVID are actually here to stay,
Yeah.
um, because I think they have fundamentally just removed certain behavioral barriers that inhibited discovery of products that were in many ways just easier to use, right? And so I think digital first financial products, whether in credit or payments or insurance, are really here to stay, even in the post-COVID world.
Yeah. So it sounds like, just from listening to what you were saying, on the consumer side, you're seeing quite a robust recovery, right? So, and you benefited because people are transacting online versus offline. How are things looking today on the SME side?
So, I think one of the major insights for us over the last few years has been that there is to some extent, I think, a false dichotomy between consumer and SME, right? I think typically in India, financial institutions have been organized by product instead of around the customer.
Hmm.
And I think what we have seen is actually a large proportion of our customer base, which is sort of the next frontier for financial services like yours, is
Yeah,
self-employed, right? And I'm
right.
sure this is a trend that you see in your customer base as well. And I think for a self-employed individual running a micro business, there's really a blending between personal and professional needs, right?
Yeah,
I think what has definitely happened in COVID is I think personal requirements for financing, so around savings, around insurance, around kind of purchasing, that has come back much more robustly. I think the same person who perhaps is using a product to buy online maybe is still a few months away from considering growth capital to grow their business or expand their dental practice or buy more inventory for their shop. So I
yeah,
think the demand for capital for debt capital for business growth, I think is probably coming back at a slower pace
mm,
than the demand for personal needs, but it's very much coming from a very similar set of customers.
right.
And
So
I think
then,
that's a very natural phenomenon that will start to converge as we start to come out of COVID, hopefully in the new
yeah,
year.
so maybe then like the increase in demand on the personal side could be a leading indicator for your, you could say, business side.
I think so, and I think even on the business side, what we see is that entrepreneurs are a lot happier taking more granular loans and
Right.
taking kind of a low and grow approach, which works well for us as well, coming out of COVID. um, and kind of happy to take, let's say, a 2 lakh or a 3 lakh small working capital loan as opposed to, let's say, 10 lakh or a 15 lakh one, right? And I think this very much mirrors, as we all know, Indian entrepreneurs are very savvy, right? And very conscious about debt and how to use it effectively in the business. And so I think what we're seeing is that in certain pockets like healthcare or e-commerce or kind of home appliances or agri commodities or pharma, there is obviously a kind of faster return to demand for growth debt financing. In other sectors that are slower to recover, I suspect we will start to see kind of green shoots over the next 2 quarters.
Yeah. So then I guess that's a good segue into talking about what's next. So on the product side, then, what do you think are going to, what do you think are going to be the developments that we'll see, say, the next couple of years, or just coming out of COVID? What's the trends that you think are going to continue or start?
Rohit, I honestly think that the biggest legacy, if you will, of COVID is that customers are going to remember um, who was useful for them during this period.
Yeah.
And I think a lot of deep kind of brands and customer franchises will actually have been built during this year. And so I think for us, for being able to kind of double down on this customer base and over time become a one-stop financial partner is really the holy grail of the next phase of growth for Capital Float, right? And I think credit is very much at its core because we believe that kind of developmentally as an economy, payments came first in terms of digital and then credit and then insurance, savings, banking, etc. So we believe that kind of credit is in many ways the hook into the informal sector and into the missing middle. But it's the starting point to be able to build an ongoing relationship with the customer and be able to offer multiple products and services depending on what's right for them at their life cycle. So I think for us, kind of really kind of building this customer franchise, creating offerings that are able to scale as our customers grow in income and age and family complexity is super important and probably the number one priority for us going forward. And being able to create more utility from our products and services for this customer base is really what we're going to be focusing on.
Yeah, I mean, I would definitely make a similar observation. So normally, people think Indians are very price sensitive, right? And they will do anything to get a slightly better bargain, and the value of time versus money is in favor of money always. And then indeed, I mean, if you look at the bank market, they compete on price. One bank is offering a personal loan at 10.99%, another will say 10.89, and another will say 10.79. But what I've seen, particularly in this mass market, if you provide them a good service, actually the price sensitivity or price elasticity is very low. And if you're there when you need them, if you provide a product with a good turnaround time of delivery, they'll come back and they'll keep returning. And then, as you say, the objective then is, well, how do I capture more of this person's value, right, over time, their family as well. Because most customers are pretty young, there's a very long lifetime value ahead of them. But
Exactly.
if we just take ourselves out of our own personal context for the time being, right? Like, what about just generally in India? Which products do you think are going to do well? Which products do you think might not do well or are not going to be so much in flavor? How do you think about that?
That's a very interesting question, Rohit, and I'll do my best attempt at a crystal ball. Um, I think two or three themes come to mind. I think the first is around credit embedded into the daily lives of individuals, right? I think a lot of the financial inclusion story in India over the last few years has been very much around loans. And I think there's a fair reason for that, because loans are a one-time transaction, hence it's easier to manage risk. It is easier to manage CAC and OPEX. They're also longer tenure, so they're lower maintenance to service,
Yeah.
particularly when you're operating on the frontiers. But I think fundamentally, what the next wave of 100 million so Indian financial services customers are looking for are actually kind of day-to-day credit products, right? Now, this could be a simple line of credit to make your purchases, to pay later, or it could be something for your business to kind of fulfill an order or procure something on credit, right? Or kind of make a certain payment on a deferred cycle. And so I think this ability to create in many ways a sort of the future credit card for the Indian self-employed and thin file customer. I think that is going to be a holy grail that a lot of us are going to be going after. And
It's pretty.
essentially what sorry, go
Yeah,
ahead.
no, you go ahead. Continue your thought, then I'll ask.
So I think obviously the credit card is a sort of 70-year-old product, right? So I think there's huge opportunity for innovation here. But essentially what I'm saying is kind of the ability to embed credit in a very seamless way and into the day-to-day life of an entrepreneur or an average consumer, and make it both affordable and useful, um, kind of on a more regular basis. I think that's going to be one of the major themes going forward.
So yeah, I just want to explore that a bit. So I mean, effectively, you're talking about quite short-term credit, it sounds like, right? So you've had your buy now, pay later. Say if someone's checking out on Amazon, they buy a mobile phone, and then they can take a loan from CapitalFlick to finance that purchase, let's say over 6 months. And then you've got these other companies, let's say Simple, Lazy Pay, which often do, I'm buying a movie ticket from, book my show, and then in 15 days time, I can clear that balance, right? What you're talking about though is something different again, which is, I want to clarify this. Are you talking about exploring, say, 15-day, 7-day, 15-day, 30-day products, or are you talking about something different? Like, how is this different to a payday loan, I guess?
Yeah, no, it's a great question. I think ultimately the real killer product here, if you will, solves both an affordability and a convenience problem, right? And I think it has multiple use cases for the customer. So almost imagine like a sort of like a kind of super line of credit, right? That you can use for your business needs. You can use it for a personal requirement. You can use it to buy something. But it's essentially kind of one seamless offering
Yeah.
that allows you to meet multiple needs at the same time. And that's very much what the credit card set out to solve. But I think ended up becoming a very much a premium sort of prime product in India. And I
Yeah.
think this is not dissimilar to what you see it happening a lot of businesses, right? A lot of kind of small businesses, small shops typically run lines of credit with their suppliers, with their customers. They actually run a very complex network of credit relationships that are much less about large, chunky exposures or kind of asset-backed financing and more about day-to-day working capital, whether for personal or business needs, right? And I think that's the solution that's waiting to be cracked. I think historically, a lot of the lending to the underserved has been, hey, I'm going to give you a 3-year business loan or a personal loan, or I'm going to give you a loan against property or gold or something like that. Whereas I think the real opportunity and the need out there is for a more flexible kind of product that kind of runs in parallel to a person's daily needs, whether in business or personal life.
Yeah, I definitely agree. So we've just got a few minutes before the Q&A. So let's talk about, I guess, entrepreneurship. So there will still be people out there who are considering this route themselves. What advice would you give someone who wants to be a fintech entrepreneur?
Um,
It can be a lending one, it can be a fintech one, or just an entrepreneur generally. What would you
so
say?
I'll stick to fintech because I have at least some experience to show for that. Look, I think the financial services opportunity in India is probably one of the most exciting opportunities in the world, right? I think it's a deep profit pool. Financial services typically grows at a multiple of GDP, so it's very much indexed to this dream of India becoming a 5 trillion economy. And it's also one where um, I would say there's kind of the monetization path is very clear, right? Which I think is very important in India when you're building a business and kind of paths to profitability and things like that. So I think it's extremely exciting. I think one piece of advice I would give is if you decide to jump into this, don't be afraid to roll up your sleeves and do the hard stuff, right? I think there's often a tendency among kind of entrepreneurs, especially who come from more of a kind of tech background, to stay away from things like risk or kind of managing liquidity or liabilities or a balance sheet or kind of doing on the ground ops, fulfillment, etc. And I think ultimately, if one really wants to crack the next frontier of financial services in India, um, there is obviously a massive digital play, but you also need to kind of get into questions like risk and capital sources and fulfillment and collections. And I think these are actually very fulfilling areas where tech can play a major role. But it just requires you to kind of roll up your sleeves and get in. And so my advice would be kind of get your hands dirty and don't try and take the easy way out.
Right. Yeah, I mean, like you have to be on top of all of these things because lending's an unforgiving business, and we'll continue to have economic gyrations. There'll be another crisis coming up, so you have to be on top of all these things. I mean, even in the best of times, you have to be on top of these things. But if you're caught short, you're in trouble. I guess then the last question I have is, what would be your advice for someone like myself who's an earlier stage entrepreneur? Like I said, our company is 2 years old. What would you say for someone in my position?
I think it's very there are a lot of interesting opportunities in this space. There's almost infinite possibility, and I think one of the challenges is always kind of how to hold yourself back and not diversify too quickly too early.
Yeah,
Because I think each of the opportunities is large but takes a lot of effort and discipline to crack. And so I think finding the right balance between growth and discipline, which is sort of the age-old banker dilemma, is very much kind of germane here. And I think, yes, a lot of traditional financial services perhaps errs too much on the side of caution, but kind of the new age approaches can sometimes go too far in the other directions. I think it's about kind of finding that balance between focus and experimentation, growth and discipline. And obviously, there will be kind of natural mistakes and learnings along the way, and that's part of the game. But I think just being conscious of that balance and kind of which side of it you're coming on and knowing why you're choosing that side at a given point in time and creating the right guardrails, I think is super important.
all right, great. So I think that leaves us some time for Q&A. Apurva, do you want to moderate?
Yeah. Thank you, Rohit and Shashank. That was a very thought-provoking discussion. We do have some time for Q&As. I'll read out the question first. The first question is, what's the outlook of lending in India in the next few years? Do you want to take that up, Shashank?
Sure. I think it's an extremely interesting opportunity. It's been variously sized at anywhere from $500 billion to $1 trillion. I think more importantly, no country in the history of the world has grown at 7, 8% for a decade without a concurrent expansion in credit, and that too retail credit, right? And I think India is still extremely underpenetrated, whether you look at retail debt as a percentage of GDP, bank branches, all of that stuff, right? So I think it's a very large opportunity. I think the key is to kind of find one's niche and really build a capability and expertise that makes you better than anyone else in that niche.
Yeah, like I would just add, I'm also extremely bullish on the opportunity here. There's still a paucity of credit being supplied to the economy. And over the next couple of years in particular, there's a even more exciting opportunity as a new entrant, or if anyone's got a clean balance sheet, to expand your presence and grow your business, because a lot of the traditional businesses, whether it's banks or NBFCs, are on the back foot right now, right? They've got to repair their own balance sheet. They are very risk averse. So that created a vacuum almost that needs to be filled. Like Shashank talked earlier about coming out of COVID, you've been able to lend to better quality customers, higher quality customers. We've seen the same thing as well. Lots of lenders are not in the market at the moment. So to give an interest rate, I can now attract a better quality customer than I could before, because there's no one else lending, right? So actually, I think it's very exciting. Like we're definitely really positive about the opportunity.
Right. So I will read out the next question. Thank you. How should we value the new age fintech lenders, given that they have many off-book partnerships too? Typically, P/B ratios will not capture the entire scale of their business. So, who would like to take that up?
Rohit, as a former banker, I'm going to punt this to you.
No, I was just a trader. I just bought stuff and hoped it went up. No, sorry, can you just say that again? As something you said, off balance sheet something.
Right. So how should we value the new age fintech lenders, given that they have many off-book partnerships? Typically, P/B ratios will not capture the entire scale of their business.
Yeah, to be honest, I think this is similar to any sort of tech business, which is, I mean, normally if you're valuing an NBFC or a bank, you have the balance sheet, you can say, okay, it's fairly stable, there's some price to book value depending on the quality asset and what's my earnings, cash flow, etc. That will be the case for fintechs in a much more mature state, but at the moment, at the earlier stage, it's a combination of assets under management, growth trajectory, and performance, right? Is this company able to grow while maintaining performance? Has it got enough supply of debt to keep that going? And as Shashank mentioned earlier, actually there is a clear path to profitability in this business. Like the business is the same as any of these lending businesses which are traditional, which is we typically borrow at a rate X, we lend at a higher rate Y, and we have a spread, right? So what's the present value of that spread as it grows? Is the ultimate way to do it. But when it grows growing very quickly, it will trade a bit like a tech company in the shorter term, but it will become like a finance company in the longer term.
Right.
But the short answer is just value it high, and then we'll all be happy.
Right. All right. So another question. So we would like to know more about what all checkpoints in lending can technologies like machine learning, AI can help making it more optimized.
Sure. So I think, look, it's actually fairly straightforward, right? I think there are kind of four aspects to lending and really any kind of financial product. The first is customer acquisition, the second is underwriting, the third is funding, and then the fourth is customer management, right? Which is everything from retention to driving LTV, upsell, collections, etc., etc. And I think the way we see it is kind of lending is a relay race, right? You have to go through each of these four stages with every customer. And technology is kind of has a major role to play in each of these four, right? Whether it's in terms of reducing cost, improving accessibility, creating more delightful products, or managing risk better through kind of better data sources, better underwriting models, kind of faster iteration cycles on the models, etc. So I think the short answer is, like you would look at any kind of traditional business and its disruption through tech, lending is no exception. It kind of happens across the value chain.
Yeah, I guess the only thing I would add to that would be, so, as it just described, it makes different points of the life cycle more efficient or better. The other point just to add is, because you can have a completely digital process now, the cost of providing a loan is a lot lower, which means a small loan becomes viable, whereas before it wasn't. So if you go to a bank, there's a reason why typically it's a minimum loan of 1 lakh, because they have such a heavy cost overhead. Think of all the branches, think of all the staff, legacy technology systems. So it's very expensive. So what this allows you to do is do a small loan in a viable way from an economic standpoint, which means you can now provide access to credit to many millions of people that didn't have it before. And you can reach all corners of the country, which before they had nothing. So as well as making a better product, it allows it to reach more people.
Right. Thank you for sharing that. We have one last question. I think we can, in the interest of time, keep it brief. So, what, according to you, defines the success in digital lending?
Collecting.
Right. One would answer. Right. So, thank you, Sashank and Rohit, for sharing those wonderful insights today. And we had a very insightful conversation. So, also to add, our recent report on Indian tech startups on Road to Recovery states that startup business recovers 3 times growth, showing revenue recovery over Q1 2020, and runway increases 5 times growth in tech startups with 6 months plus runway over Q1 2020. And you can download the detailed report with the link shown in the chat section. And our next session is on future of fintech, innovation in financial inclusion, which is happening on 8th of December. And I look forward to meeting all of you again over there. So any closing notes? Thank you. Thank you.
Thank you.
Thank you.